Am I clearly audible for everyone? Can we start?
Yes, sir, we can hear.
Right. Okay. So, on behalf of JMC vLearning, I welcome you all for the AAT mock paper discussion series. We have been doing this for the 7th consecutive time now, and a lot of students so far over the past few years, they have been benefited when we were able to produce first in order of merit prize a couple of times. We were able to produce because of this series. And thank you for joining for this program, right? And you all might be joining live, or some of you might be watching the recording later on. So I hope you all get the maximum benefit. Especially you all are facing the first examination under the new curriculum. Therefore, definitely there will be differences compared to the previous one. So I'm using the pilot paper given by AAT, which I actually prepared for AAT, so that we can use that paper because that is the only guidance, right? So without taking that much of time, I think we should be able to move towards the session. Right. So let me share my screen. Right. Okay. I hope the screen is much clearly visible to everyone. Is it? Nadisha, can you see? Others? Can you all see the screen? Lamai? Yes. Tatsara?
Yes, sir.
Yes. You can see, no? Right. Thank you. And please, you'll have to respond, huh? Right? Okay. So I think we should be able to start now. Right. Okay, we'll start from the question number 1. You know, in the part A, you got 20 questions. Of that, 10 are MCQs, 5 are true or false, and 5 short answers. We'll start. Select from the following a main objective. They're asking us to find a main objective of financial accounting. Right. Provide information for managers. No, managers, it's a management accounting. Provide information to the government. That may not be the main. Understand the financial performance. Yes, that's a correct answer. To decide the selling price? No. So we are providing the financial performance, financial position to the stakeholders for them to take economic decisions. Neither. Right. Look at the next one. Kapila Traders has returned. Kapila Traders has returned 4 million worth of goods purchase. It's a purchase return on credit to DGL. It's a purchase return. Then they ask in the source document. When you are purchasing on credit, the creditor goes up. That means credit. When you are purchasing, the creditor goes up. Credit. But when the purchase are being returned, creditor is coming down. That means creditor gets debited. Creditor gets debited. Therefore, it's a debit note. Debit note. Okay. I believe you all have the paper, right? You all have the paper with you? Right. Or paper එක දාන්න ඕනේද? Right. I put the paper in the chat as well. Right. Okay. We'll move on to the next question. Sarat Traders has purchased an office equipment. For rupees 200,000 for office use from another company called Metropolo on credit. So basically, you are purchasing an office equipment on credit. So they're asking us to put the double entry. So definitely the office equipment will get debited. So office equipment gets debited. And where to be credited? So we don't use the accounts under the names in the general ledger, it's impersonal accounts, no, right? So we have to credit, but not the trade payable, because we are purchasing an office equipment. So it goes to other payables. So debited to office equipment, credited to other payables. Right. Question number 1.4. Navas Traders is a sole prop owned by Navas. Telephone bill of Navas was paid by the business and it was considered as drawing. Telephone bill of Navas considered as drawings. They're asking the accounting concept. The accounting concept that says the owner's income expenses are different with business income expenses is the entity concept. So the correct answer is the entity concept. Entity concept. Right. Select from the following a general accounting package. What are the general accounting packages? Tally, QuickBook, Sage, Myobi, Peachtree. So the answer would be Tally. That's a general package. If it is specialized for some task, then like payroll, inventory, then it's a special package. Right. 1.6. They have given us the capital, the profit, the liabilities, and the drawings, asking us the total assets as at the year end. So you need to use the profit equation, right? Profit equals closing equity minus opening equity plus drawings minus additional capital. Right. So then here the profit is given to us as 1.8 million. I'll put as 1,800. Closing equity is basically your closing assets minus closing liabilities. Minus opening equity is 5,000 plus drawings 400. There's no additional capital. 1,800 equals closing assets minus closing liabilities are 2,750 minus 5,000 plus 400 is minus 4,600. Right. I will try to solve this. 4,600 here plus, so then 8,008 plus 4,600, 6,400. Closing assets. Remove the brackets now. Minus 2,750. Minus 2,750 to the other side, then 6,400 plus 2,750. 9,150 is the closing asset. So the answer is 9,150,000. Clear? So here you have to use the profit equation. What is the profit equation? The closing equity minus opening equity, that's the equity difference. You add back the drawings which has been deducted and you deduct the additional capital which has been added. So that's the formula. Then you know the equity equals asset minus liabilities, no? So closing equity means closing asset minus closing liabilities. Closing assets minus closing liabilities. We are using this equation to finally get the answer. Okay. Right. 1.7. Which of the following item is an element of statement of income? Statement of income, statement of profit or loss, both are the same. Statement of comprehensive income, the same. There you are going to put the income and expenses. So item would be the income. Right? Income would be the answer. Right. 1.8. Conventionally, the ledger accounts can be classified as nominal, real, and personal. Correct classification of drawings. In the ledger lamai, we classify the accounts as nominal accounts and real accounts and the personal accounts. The real accounts are the asset, liability, and equity account. Asset, liability, and equity. Nominal accounts are the income and expenses. Personal accounts are the accounts we kept under the personal names, the subledgers, debtor ledger, and the creditor ledger. Now, there's one exception for the drawings. Drawings is not an income or an expense, but we open up the drawings for a financial year. Towards the end of the financial year, we transfer it to the equity. Therefore, drawings is a nominal account. Drawings is a nominal account, right? It's not a real account. It's a nominal account. It's not an account we continue. Okay. Right. 1.9. Select from the following the underlying accounting concept that allows the measuring inventory at lower of cost to NRV. Right. I will take this example of this calculator. Let's say the cost of the calculator, it took me 2,000 rupees to manufacture this. 2,000. Right? I invested 2,000. I incurred 2,000 to manufacture this. That is the cost. I can sell this calculator at a value of 3,000. I can sell. The net cash flow I'm expected to generate is 3,000. That's my NRV, net realizable value. Cost is the amount incurred. 3,000 NRV is the amount I'm expected to get. So, of these two values, 2,000 cost and 3,000 NRV, you have to keep it at the lower. Why? If you keep it at 3,000, you are recognizing a profit 1,000 which has not realized yet. You haven't sold the item yet, no? And the inventory will get overstated. You cannot manipulate the accounts. You cannot put the 2,000 worth of calculator at 3,000 and recognize the profit. Then you are manipulated because you haven't done the sale. So, the accounting concept which says do not manipulate is the prudence concept. Right? Okay, next one. Unimo traders settled an invoice of 200,000 to the trade creditor subject to a discount of 5%. What is the impact on accounting equation? So there's a liability worth of 200,000 and you are going to settle it subject to a 5% discount. 200,000 into 5% is 10,000. So technically your liability would come down by 200,000. But you are going to pay only 190 because you are getting a benefit of 10,000. So cash will come down by 190 and you are going to recognize the benefit of 10. Liability comes down by 200,000. Right. So the correct answer would be number 3. Right. Look at the next item. True or false? Objectivity is a principle of code of ethics. Yes, definitely. Objectivity is a code of ethics technique. Right? So it's a true statement. Right? That's a true statement. Right? Objectivity, confidentiality, isn't it? Right? Being integrity, these are the ethics. 1.12. As per the accrual concept, revenue is recognized in the particular accounting period irrespective of receipt of cash or not. True. Right? So, we don't care whether the cash is received or not. We don't care whether the cash is received or not. If the income has been incurred, we have to recognize. Whether cash received or not, we don't care. the income is being incurred, we have to recognize. So it's true. All the accounting errors can be detected by the trial balance. That's false. You cannot. Not all the errors. Right. 1.14. Relevance is a fundamental QC. Yes. Relevance and faithful representation is a fundamental QC. True. General ledger is a prime entry book. That's false. General ledger is not a prime entry book. Right. Look at the next one. Select the source document for the following two transactions. Part A, bad debt. For bad debt, the source document is the journal voucher because it's a general journal transaction. Journal voucher. Part B, purchase goods on credit. Purchasing goods on credit, that's the purchase invoice. Right. Purchase invoice. Okay. Right. 1.7 list two disadvantages of computerized accounting software. Right. When it comes to computerized accounting software, you have initial high cost. You got initial high cost. Then there's cost of upgrading and maintenance. And there's a data security threat. Risk of viruses and cyber attacks. Plus, there can be a requirement of people with know-how. So yes, softwares, there's a cost. Yeah, initial there's a high cost that you have to incur, and you have to upgrade, you have to maintain. There's a data security threat, virus threat, cyber attacks can be there. And the requirement of people with know-how. Requirement of people with know-how. Because you need people who know this. Computers accounting packages, not everyone can do that. But you need people with the knowledge. Right. Look at the next one. Trade receivable control account balance as at 31st March of Gimsara is 100,000. But the data ledger was different. And following reasons were identified. Find the corrected trade receivable control balance. We'll prepare the trade receivable control balance, control account. Trade receivable control account. The opening balance was 100,000. Right. Bad debt written off. As a result of the bad debt, the debtor balance comes down. As a result of bad debt, the debtor balance comes down. An amount received from the debtor was understated. When you are receiving the amount, the debtor comes down. When you are receiving the debtor comes down, you have to put a lower figure. So cash 8,000. Third one, sales journal was overstated. So you have put higher sales figures. So the balance is high. To reduce, we have to credit. Accordingly, the corrected balance would be $77,000. 77,000 is the correct balance. Okay. Right. Look at the next one. State two examples of current liabilities. Very easy. Current liabilities, trade payables, other payables, accrued expenses, tax payable, bank overdraft. You just have to write only two. Trade payables, other payables, accrued. Right. State two benefits of preparing a trial balance. What are the benefits of preparing a trial balance? To check arithmetic accuracy, to check the posting of double entries, to check whether balances are tallying, to prepare the financial statements, to get an idea on closing balances. Right. So you can check the arithmetic accuracy, right? So you can check whether the trial balance is getting balanced. Are there any mistakes? You can check the double entry posting, whether it is okay, whether the balances are tallying, and you can use it to prepare the financials to get an idea on the closing balances. Right. Okay. Right. Bye-bye. Are you all okay? Can we move on to the part B here, section B? We are done with section A. Any questions, clarifications on section A? Okay, then. What is that? Okay, the right. How about the others? Aniklamai, Gatati. Response kara. Others okay, the Vihara, right? Metuka, Rashmi, Shenal, Vikram, okay, the Adisha. Right? Right. Okay. Now we'll move towards the part 2. What are they asking? You have to prepare an impact on accounting equation. These are the items for 7 marks and calculate the profit for 3 marks. Okay. We'll prepare the format. We got machinery, inventory, trade receivables, cash, equity, liabilities. Machine inventory. Right. Okay. We're good here. Right. Okay, we'll start. First transaction. Right, we look at the first transaction. Hasali invested 500 in cash and 1,005 worth of machinery as the initial capital. Right, okay. Right, the machinery 1,005, cash 500, total equity 2,000. Machinery goes up by 1,005, cash goes up by 5, equity goes up by 2,000. Right? Part B. Purchased goods worth 800. Purchased goods worth 800 from Mota on credit. Right? Mota on credit. Okay, so we'll put we are purchasing 800,000 worth of items from Mota, which is a creditor. It's a liability. Inventory goes up, creditor goes up. Inventory goes up, the creditor liability goes up. Goods costing 300 was sold for 500 on credit to Ashini. So inventory comes down by 300. You are selling it to 500 to Ashini. Thus you are recognizing a profit of 200. At the same time, we'll mark the profit as well. Profit on sale 200. 300 inventory comes down because you are selling 300 worth of items for 500. Data goes up. Thus you are recognizing a profit. Next one. Electricity. Give me a second. This thing is not working. Let me try again. Huh? Right. Reason of pen is not working now. Yeah, anyway. Electricity bill for the month was 200 and it was paid by Hasali on 15th April. It was decided by Hasali to consider this amount as an additional capital. To consider this as an additional capital. Now, electricity bill of the month of April 200 has been paid by Hasali, the owner, by herself. And it is considered as an additional capital. Then what will happen? Right? Electricity is an expense. Therefore, the profit is coming down. At the same time, owner is paying it by her personal money and consider it as a equity capital, equity funded, additional capital. So the equity goes up by 20. Right? Equity goes up by 20. Clear? So one side, your right? Right now, what is happening? One side, this is an electricity bill. Because of the electricity bill, right, which is an expense, my profit is coming down. At the same time, it has been paid by the owner by herself. Therefore, it's considered as an additional capital. So profit comes down, additional capital equity goes up. So we'll put the electricity, which is an expense, minus 20. Right. Fifth one. Ashwini settled 400,000 subject to a cash discount of 10%. So you are going to settle 400,000 subject to cash discount. Liability will come down by 400, but your cash will come down by only by 90%. Why? You are getting a discount. So 400 into 90%. So your benefit is 40 rupees. Okay? So when you are trying to settle 400 to the supplier has told you, okay, since you are settling early, I am giving you a discount of 10%. So you don't have to settle, you don't have to give cash 360. You don't have to give cash 400. You have to give only 360. So cash comes down by 360. But they are waiving off 400 entirely. Credit balance. So you have been benefited by 40 rupees. The discount received. Discount received 40. Hasali has taken 50 rupee worth of goods for her personal use. That's a drawing, no? So the inventory comes down, equity comes down. Inventory comes down, equity comes down. When the owner is taking the inventory for her personal use, inventory comes down and the equity comes down. Depreciation, 10 rupees. Because of the depreciation, asset comes down. And depreciation is an expense, profit comes down. Depreciation is an expense, profit comes down. Right? So the profit, corrected profit is, profit for the month is 210. So we are done with putting all the 7 items. Right. Okay. Right, Lama. Are we okay up to the question number 2? Are we clear? If you don't understand anything, just let me know. Right. We're done with question number 2. We're coming towards question number 3. We're supposed to prepare the sales journal. Sales journal. We'll prepare the sales journal. Date. Invoice number. Description. Amount. Right, you're supposed to prepare the sales journal. You know the format, date, then the source stock number, then the description and the amount. It's very easy format, not a difficult one. We have to always take after trade discount. After trade discount. Right. Let's look at first one is for 5th of April. Invoice number S145. Tamidu Traders is the supplier. About 200 kilograms at 200 price. After a discount of 5%, then you have to take 95%. 38,000. 200 kilograms into 200 per kilogram into after discount means you have to take 95%. Right, next one, 2025 10th. This is 146. Rosero Traders. Let's look at the pricing. 500 kilograms into 250 into 10. 10% is the trade discount, so you have to take after trade discount. Just take 90%. 112,500. Right. Next one, we got 14th and 20th. Right. So S147, Chama Traders, 300 kilograms into 500. 8, Sajida Traders, 100 kilograms into 180. After discount is 95%. So the total is 317,600. Right. Look at the next one. The question says something like this. Bank balance as per the bank statement of Manuka Traders did not agree. The cash control account, which had a balance of 200,000 and the statement balance was 270. You've been asked to prepare the adjusted cash control account and the bank rec. You got 6 items. So you have to prepare the adjusted cash book and the adjusted cash book. Opening balance, which is 200,000. Then here the balance bank reconciliation. Balance as per adjusted cash book plus minus balance as per bank statement. These are the formats which we need. Okay. Okay, Lemon. Right, we got the adjusted cash book and the bank reconciliation. For the bank reconciliation, we have to show the timing differences, the unrealized deposits and unpresented payments, and the errors by the bank. But all the others are adjusted to cash book. It's very easy, not a difficult thing. Let's try. Manuka Traders has given a standing order to pay the monthly loan installment of 50. And it has been omitted. Then what we should do? We have to adjust now. Because of the bank loan, the balance is coming down. Loan. Very easy. There's a direct deposit of 65, but not recorded. So we will record here 65 direct deposit from a debtor. A check of 100,000 was given to supplier Minoli. However, it was presented on 2nd of April. That is after the month. Okay. They are given a check of 100,000 to Minoli, the supplier, on 28th March. What was presented on 2nd of March. This is an unpresented check. Unpresented check. So then we'll see how does it work. Right? How does it work? Right? So let me show you. So in the bank rec, we are trying to reconcile from the cash book to statement. I'm taking this end as the cash book, this end as the statement. First of all, think the balances are equal. You have issued a check. Means the cash book balance comes down. When you are issuing, cash book balance comes down. But it has not presented to the bank yet. Yet it has not come to the statement. On 31st of March, it has not come. So the statement balance is high. Now in the reconciliation, you are going from the cash book to the statement. From the cash book to the statement. From the lower to the higher. From lower to higher, you need to add. So the unpresented check, 100,000 we have to add. Cash book, bank statement. There's a check issued, so the cash book balance comes down. Not presented, bank statement remains the same. From the cash book to the statement going, so we have to add. Next one. 80,000 deposited was remain unrealized. 80,000 deposit remains unrealized. Once again, it goes to the reconciliation. Cash book, your bank statement. Cash book, bank statement. Cash book, bank statement. Cash earlier. First of all, we think the balances are equal. Deposited 80. You have deposited 80. So the cash book balance is high. Not realized to the bank yet. It has still not come to the bank yet. Statement balance is lower. From where to you are going? From the cash to the bank. From the cash book to the bank statement. From higher to lower, you have to deduct. Right. Next one, bank charge 5,000. Because of the bank charge, the cash book balance comes down. Right. 6th one, bank has erroneously credited 40. Bank. It's a bank error. Bank has erroneously credited. You know, Lamai, our bank account is an asset for us. For us, it's an asset. So increase is debit, decrease is credit. But to the bank, the same account is a liability. Right? For the bank, our accounts are a liability. Are liabilities. So for them, when the bank account balance increases, it's a liability increase of credit. When it decreases, it's a liability decrease of debit. Right? Therefore, here they say bank has erroneously credited. Liabilities are credited means balance is increasing. So cash book, bank statement, cash book, bank statement. Bank has erroneously credited means bank statement balance is high by 40. Bank statement balance is high by 40. In the rec, you are not trying to correct the errors, you are trying to show the error. Now from where to you are going? From the cash to the bank. From the cash to the bank. So you need to add. Bank error, you are going to add 40,000. Right, now I can close down the account here. So the closing balance is coming to 210,000. So the bank statement gets tallied at 270,000. 270,000. Okay. Right. Any concerns, clarifications on this part? Cash book and the bank statements. Are you okay up to this point? Right. Right. We'll move towards the next question, question number 4. Right. So my question number 4 is asking us to prepare the manufacturing account. We'll start from the beginning. Udara Publications is engaged in book printing. Following extracted, you got the items here. Remember, work in progress is on prime cost. Okay. Then you have the inventory, closing inventory balances. Expense allocations are given to you. They are saying plant and machinery are used to print books, but the motor lorry is used to deliver. So that means my plant and machinery depreciation is part of my manufacturing cost, but not the lorry depreciation. Because lorry is being used to deliver the finished good now. Manufacturing account will factor the cost incurred to manufacture the items, not beyond that. So machinery depreciation is something that matters to us. A machine minder are given a production incentive of 50 per book. 10,000 books were printed. Manufactured items are transferred to trading provision at a profit of 20% on cost. Right. Let me draft the statements. This is Udara Publications, manufacturing account for the year ended 31st March 2025. Rupees. We start with raw materials. Opening raw material stock. Purchases. Right, then carriage inward can be there. Deducted closing raw material stock. Then we are arriving at raw material consumption. Then you have the direct labor, have the direct wages, and production incentives, direct other. Then you have the prime cost. Have plus opening work in progress minus closing work in progress. You arrive at prime cost of completed items. Then you have the production overheads. You will arrive at the production cost. Then the factory profit. Finally, you arrive at the transfer price. Right. This is the format. Please drop a message if you are done with the format. Huh? We can do the question in thousands, I guess. Be little easier. Alright, format එක done නම් මට message එකක් දාන්න. If you are okay with the format, just drop a message. Yeah, thank you. Yeah. Right. Okay, then. Okay, shall I start now? Shall I start? Right. Okay, we'll start. Very easy. Manufacturing accounts are not difficult. First one, closing raw material stock. That means the raw material stock which is not consumed. So we have to remove that. Neither which is not consumed is something that we have to remove. 300. Work in progress. That means the as of 31st of March, what were the items incomplete? Items which are incomplete, we are removing from the manufacturing account. Why? Because manufacturing account calculates the manufacturing cost of completed items, not the incomplete. So we are deducting 430 here. It's very easy. Then there are 3 expense items which has been divided among factory and the office. We have to take only the factory component. We'll take security at 70%, electricity at 80%, rent at 80%. We'll come to the figures later. Plant and machinery depreciation, yes, we need to factor. So you'll have to take the machine depreciation, which is at 20%. Right. We'll come to the cost later because while we take the balances from the given items, we can take it. Right. Difficult one. So you have to take just 20% of the depreciation. We took the security 70, electricity 80, rent 80, machine depreciation 20%. Lorry depreciation, that's a distribution cost. Then the minder's incentive, how much is that? Minder's incentive, it's 10,000 books. So we are giving 50 for 10,000 books. So I'll be taking the at thousands. So 50 into 10 is 500. Because I'm doing it in thousands, so I'll be taking 10,000 as 10. You are keeping a profit of 20%. Right. Profit is at 20% on cost. Good. We are done with all the workings. Very easy. We are done with all the workings. You can see manufacturer account is the easiest. You can score all the marks. Just take the balances. Raw material opening stock 500. Purchases 6,000. Work in progress opening balance 230. Carriage inward 100. Carriage inward 100. Direct wages 2,500. Machine maintenance 60. Security 600. We just have to take 70% of that 600. Electricity 80% of that 900. Rent you would just take 80%. You have to take the depreciation of the machine. Right. You're done with it. PCPC. Material consumption 6,300. Direct labor 3,000. So the prime cost 9,300. Prime cost of completed items 9,100. So my production cost 11,500. So the transfer price is 13,100. Right. Okay. Shall we move on to the question number 5? Bye-bye. Question number 5 is on correction of errors. You need to prepare the journal entries, suspense account, and a statement to correct the profit for 10 months. You got around 7 transactions. They're saying the trial balance of Tarun traders prepared by the account executive did not agree. The difference 170 was credited to a suspense account. Using the trial balance, the draft financials were prepared and there was a loss of 450. Right. So let's see, let's prepare the formats first. General journal, debit and the credit. Then the suspense account, it has a credit balance. I'm doing the patient in thousands. Then you have the profit statement. You have the draft profit, which is actually a loss, 450. Things that you are going to plus, things that you are going to minus. Always remember what you are going to plus is basically the credits, your income expense credits. And what you are going to deduct is income expense debits. Accordingly, you will arrive at the corrected profit. Right. Put the formats and let me know if you are ready with the formats. If you are done with the format, just let me know. Right, Lamai, please let me know if you are okay with it. Done with it. Okay. Right. Good. So we'll start. Look at the first transaction. They're trying to correct the errors. Salary payable for the month of March 100 was not recorded. Was not recorded. That means omitted, right? Omitted. Was omitted, not recorded. So shall we record that? That's an omission, no? So salary expense shall be increased. Salary expense debit 100. Salary payable credit 100. Put the narration correcting the omission of salary payable. Right. Correcting the omission of salary payable. Right. It has no impact on suspense, but the profit has an impact. Why? You know, the asset liability equity account does not impact the profit, but an expense, yes. Right? Now, let me explain this as well. Now look here. When an income increases, the profit will increase. When an expense decreases, profit will increase. When an income decreases, profit will decrease. When an expense increases, profit will decrease. Right? So income increase means credit. Expense decrease means credit. Income decrease is a debit. Expense increase is a debit. So you can clearly see when an income is increasing, that means gets credited, the profit will be increased. When expense comes down, the profit will be increased. When an income comes down, the profit will be decreased. When expense increases, the profit will decrease. So there's a very simple logic when it comes to income, expense versus the profit. If an income or an expense were to credit, the profit will increase. If an income and expense were to debit, the profit will decrease. So very simple logic. Okay. So we are applying it here. We are using this logic. So when an expense goes up, profit comes down. So shall we record that? Salary 100. It does not impact the salary payable is not impacting the profit. Huh? Right. Look at the next item. Interest income 50 was recorded as interest expense. However, the cash was properly recorded. So interest income they have put as an interest expense. So ideally you need to record the interest income. No? So the correct entry should have been interest income credit 50. Now what they have done is they have put that as an interest expense. They have debited, no? They have debited interest expense 50. So we have to remove that as well. Interest expense, we have to remove credit 50. So originally it's an interest income that you have to credit. By error, they have put that as an interest expense. So that even we have to remove. There's nothing wrong in any other entry. There's nothing wrong in the cash or anything. So then the difference goes to suspense account, gets debited 100. We'll record correcting clerical error on interest income. Correcting clerical error on interest income. Right. So the suspense gets debited 100 as interest, and both are getting credited. So interest getting credited. Credit means you're adding 100. So what I can put as two items: interest income 50. Sorry. Interest expense 50. Credit, no. Credit means plus. Right, we're done with two items. Okay. Next one. A vehicle repair of 40 was erroneously capitalized. Capitalized means added to motor vehicle account. So repair has been considered as an asset. That's wrong name. So we have to correct that. So we need to recognize the motor vehicle repair expense, which is 40. Motor vehicle repair expense 40. Then we have to remove that from the motor vehicle account. 40. Yeah, removing that from motor vehicle account 40. So it's a principal error. Correcting principal error on vehicle repair. Correcting principal error on vehicle repair. Correcting principal error on vehicle repair. Right. Motor vehicle is an asset that does not impact the profit, but the repair expense does. Repair expense debit means reduction. Repair expense. What? Right. Item number 4. Stationery expense of 25 were recorded twice in the stationery, but correctly recorded in the cash. So you have debited twice the stationery. Stationery debit 25, stationery debit 25 again, cash credit 25. That's what you have. So there's extra 25 in stationery. So we have to remove that now. Stationery credit 25. There's nothing wrong with anything else. So it's a suspense account. Suspense accounts debit 25. Correcting duplication error on stationery. Correcting duplication error on stationery. It's 25. So then suspense accounts get debited as stationery, 25. Stationery is an expense credited. Credit means plus. Stationery are getting plus 25. We are coming towards the last one. Last one. Telephone expense 16 paid for the month of February has been recorded in the rent expense account as 61. However, the credit entry was correctly recorded. Okay. Telephone 16 has been recorded in the rent as 61. First of all, we need to correctly record the telephone debit 60. Then we need to remove the rent. They have erroneously put that as 61. They have erroneously put that as 61. So we recorded the correct one, the telephone, and we removed the rent. In the difference, there's nothing else. Therefore, it will be recorded in the suspense 45, the difference. 45 is the difference between these. So then we'll do the correcting kind of a clerical error or a commission error. Commission error on telephone. Correcting commission error on telephone. Right. So the suspense gets debited 45 as rent. Telephone debit means minus. Telephone rent credit means plus 61. Right. So you can see your suspense account gets tallied at 170. So your profit correction 186. This is minus. So the total corrected profit is minus. It's a loss of 420. It's a loss of 420. So Lamai, we have completed part B as well. We did part A, we did part B. We have come to the last segment in our paper, part C. Right, part C of the question paper. That is the preparation of a solved problem. Right. Let's go through the question paper. Just you have to prepare the comprehensive income, your income statement, and the financial position. We look at there's a land component which is 5 million. You got your accumulated depreciation like this. You got the trade receivable and a doubtful debt provision or the impairment provision. Data impairment means doubtful debt. Huh? Doubtful debt or the data impairment. There's something called rent paid. We will look at. Right. Your closing inventory is valued at a cost of 9,700. Electricity for the month of March of rupees 78 was not recorded. So we'll do the recording. Was not recorded and not paid. Paid on the following month. On 1st of January 2025, bank loan of rupees 8,000 has been obtained from Metro Bank to expense at an annual interest rate of 12%. Bank has given a grace period. Grace period means you don't have to pay the installment of 1 year for the capital payment. So you don't have to pay the capital payment, but you have to recognize the interest expense. Interest has not been accounted. They have not accounted for interest. Right. The policy of the business is to provide depreciation on a straight line basis, building at 10%, machinery at 20%, motor vehicle at 25%. Business entered into a new rent agreement on 1st of April 2024, 1 year back. There's a rent deposit of rupees 500,000 was paid. This will be receivable at the end of the rent period. That means you are paid. Sometimes you have to give a rent deposit to the landlord. He's keeping it until the agreement is over. After the agreement is over, you can get that money. So it's an asset for you. Rent deposit is an asset. Monthly rental is 300. Deposit paid and the rent paid is under the office rent paid. Courtroom decided to write off a long outstanding debtor of 200 rupees as a bad debt and to make a doubtful debt provision or an impairment provision of 10% for the remaining debtor balance. Right. So these are the adjustments what we are going to do. Let's draft the statements of code loop. Code loom traders statement of profit or loss for the year ended 31st March 2025, rupees in thousands. Statement of financial position. Asset. Starting with the revenue or the sales. And from that you need to deduct the cost of sales. You have the opening inventory. Purchases. Closing inventory. Arrive at the gross profit. Other income. Distribution expenses. Administration expenses. Finance expenses. Other expenses. And the net profit. Right. Then you have the non-current assets. Cost. Accumulated depreciation and the net book value. The land. Buildings. Machinery. Vehicles. Current assets. Inventory. Trade receivables. Minus data impairment provision. Rent deposit. Cash. Bank balance, cash, and the total assets. Equity, under that capital, profit, drawings, non-current liabilities, loans, current liabilities, trade payables, accrued expenses, interest payable. Right. Total equity and liabilities. Okay. Right. Once you're done with drafting the formats, just let me know so that I can start. Once you're done with the drafting, let me know. Okay. Right, Lama, if you're done with the formats, just drop a message. If you're done with the formats, please drop a message so that we can start now. Right. Okay, we'll start then. Huh? Don't take so much of time on drafting the formats. You have to do it quickly as possible. Right, the first adjustment is pretty easy, your closing inventory. There's an unsold inventory at the year end, which is an asset because next year you are going to sell it and make cash. So that's an asset, 9,700. And at the same time, so one side it's an asset because you can sell it in the next year, and that unsold inventory we have to remove from the purchases in the cost of sale. Right now that inventory is inside the purchases, which is unsold. So you have to remove that. So we are going to remove that 9,007 debited to inventory, credited to cost of sales. Debited to inventory, credited to cost of sales. Electricity 78 has not been recorded. Yes. So whether you have not paid or not, we don't care. We have to account it now. So electricity is an expense you have consumed. So electricity, we have to add 78. And we are going to add the same here to the accrued. I'm going to add 78. One side the expense goes up, other side the accrued goes up. Expense debit, accrued liability credit. Expense debit, accrued liability credit. Right. The third one, you have taken a loan on 1st of Jan. So you are not supposed to pay the loan installments for capital repayments are not required for 1 year because you have given a grace period. But you need to account for interest. How much is the interest then? It's a loan of 8,000 at an interest rate of 12% for how many months? 3 months. For 3 months. So 8,000 into 12% into 3 months. 240. 240. And you need to pay that to the, put that to the interest payable as well, because it's something that you have to pay, plus 240. Debited to interest expense, credited to interest payable. Debited to interest expense, credited to interest payable. For that 8,000 loan at 12% for 3 months, you have to accumulate the interest. Debited to interest expense, credited to interest payable. 'Okay. Right. Then the next working is on depreciation. We'll do a working for the building and the machinery and the motor vehicle. How much is the cost? Multiplied by the depreciation percentages. Building is at 10%, 20% and 25%. We'll put the cost. Land and building 11,000. Of that 5,000 is land. So the building is 6,000. Building is 6,000. Machinery 9,000. Motor vehicle 5,000. So you can calculate the depreciation now. 600, 1,008 and 1,250. 600, 1,008 and 1,250. 600, 1,800 and 1,002. Shall we record that? Building depreciation 600. Machine depreciation 1,008. And the motor vehicle depreciation here 1,250. So we are recording the depreciation expense here. So there is a one side of the entry, debited to depreciation, debited to depreciation. And I'm putting the credit entry here to the accumulated depreciation. I'll put as a plus figure, plus 600, plus 1,800 and plus 1,250. This is not the final answer because you have to add the opening balances. No, this put this as a plus balance, as a working, just as a plus, because you have to add the, you say, the opening balance. Okay. So debited to depreciation expense, we added the depreciation, and credited to accumulated depreciation, not the final balance, because you have to add the opening balance. Right? We'll do it later. This is how it works. Right. Bye-bye. Are we okay up to depreciation? Right. Thank you, Tatsar. So the next one is about the rent. Let's see what we can do here. As per the question here regarding the rent, we'll try to adjust that. Okay, as per the trial balance, the rent deposit and rent paid is 3,500. We highlighted here. Office rent paid is 3,500. That includes the deposit and the rent and the office rent paid. Deposit and the rent paid. So it is 3,500. Both rent deposit and the rent expense 3,000. Now that includes the deposit that we have to remove. So the rent deposit amount alone is 500. Here inside this 3,500, 500 is a deposit. Rent deposit is not an expense, it's an asset. You have kept 500 with the landlord because after the rent agreement you can get it. So you have to remove that now. So from the rent, I'm going to remove 500, the deposit, and I'm going to recognize it here under the rent deposit. So under the rent deposit, I'm going to recognize 500. From the rent, I'm going to remove 500 because rent deposit is not an expense, and I'm going to put that as an asset. Why? You can recover. You can get that asset from the landlord at the end of the rent period. Why are we putting that as a current asset? Because it's a 2-year agreement. 1 year is already gone, so only 1 year is remaining. Therefore, it's a current asset. Okay. So I removed from the rent expense the 500 deposit, and I recognize that as an asset. Okay. Accordingly, now how much is remaining for the rent expense paid? Rent expense paid is only 3,000. Rent expense paid is only 3,000. How much is the rent expense truly? That is 300 into 12. No, that is 3,000. 300 into 12 is 3,600. Yes, you paid both deposit and the rent 3,500. We removed the deposit now. So the rent expense you have paid is 3,000, but the rent expense is 3,600. Then the rent payable, how much? You have paid only 3,000. Rent payable is 600. Clear? Out of the rent of 3,600, you have paid only 3,000. So 600 is payable. Rent payable is 600. Payable is 600. shall we record that then? When payable is 600. Okay. So we have to add 600 here and to the accrued. We have added 600 here and to the accrued because it's a payable. We have added. Clear? So the rent payable amount of 600 was added to the expense and to the payable. To the expense and to the payable. Okay. Right. Next item, bad debt 200. So shall we write off the bad debt 200 under the distribution expenses, bad debt 200. So from the data, I have to deduct 200. I have to deduct 200. So from the I have recognized the bad debt expense 200. From the data, I have to write off 200. Bad debt debit, debtor credit. Bad debt debit, debtor credit. Bad debt expense goes up, debtor comes down. Bad debt expense goes up, debtor comes down. Okay. Right. For the remaining debtor, I have to recognize the doubtful debt provision. Shall we work on that doubtful debt provision? So we'll take the trade receivable, right? I'm going to record the data impairment or the doubtful debt provision. So I'm going to take the trade receivable balance. You all can see the trade receivable balance is 77. Already we have an impairment provision of 7. So from the trade receivable balance of 7,700, 200 was written off. So it's 7,500. 200 was written off. Then how much is the closing doubtful debt balance or the data impairment balance at 10%? So 7,500 into 10% is 750. So that means you had a data of 7,700. 200 was written off as irrecoverable. You cannot recover. The data has gone bankrupt, so you can't recover. And from the remaining debtors, 10% you have a doubt. 10% you have a doubt that you cannot recover. So you need to recognize a provision. Be prudent, you have to recognize a provision. Let's look at the carrying value of the existing provision. Carrying value of data impairment provision as of now, which is 300. Here, 300. That means already out of the data, 300 we have provided because we have a doubt, so we have provided. So we need to provide for the balance, the difference. So the under provision is 450. We had a data of 77. Of that, 200 was written off. And out of the balance, 10% we have a doubt. Of that 10%, 300 is already been provided. The balance we have to provide 400 and okay. So we'll pass the double entry for this 450. Right. So the doubtful debt or the data impairment, how much? 450. And we have to deduct data impairment will increase by 450. So one side it's an expense, on the other side I am adding that to the provision. I'm adding that to the provision. This is not the closing balance. I'll take the 300 also here and I'll deduct. For the time being, I'll keep it like this. Debited to expense, credited to provision. Debited to expense, credited to provision. Right. So you're done with all the adjustments now. So we can go to the trial balance. You can see land is 5,000, building is 6,000, machinery 9,000, motor vehicle 5,000. Accumulated depreciation, it's 3,000. You have to add plus 4,500 plus 2,500. So you have to add that. You have to add the opening balance to the current year depreciation expense. You have to add here. I'm adding the opening balance to the current year expense. Then you come to the final balance. Sales 92,000. Opening inventory 8,500. Purchases 63,000. Trade receivable 7,700. And there was a bad debt. So after bad debt 7,500. 7,700 minus 2. Data impairment 450 plus 300. Altogether I have to deduct 450 plus 3. I have to deduct 450 plus 300. So I have to deduct 7,500. So this 450 plus 300, entirely I am deducting 750. Entirely I am deducting 750. Right. Trade payable 5275. 5275. Cash at bank 500. Cash in hand 25. Bank loan 8,000. Salaries 15,500. Insurance 600. Security 750. Electricity 3,100 plus 78. Sales commission 400. Rent paid 3,500 minus 500 plus 600. 3,600. capital 13,000. Capital 13,000. Right. We're done with taking the balances. Now we need to finalize. Huh? Take the cost of sales. We will deduct 61,800. Take the gross profit 30,200. Take the distribution expenses. Take the administration expenses. Accordingly, the net profit is 1,632. Accrued expenses 678, 240. Total 28,825. They were 350. Here the total assets. So the balance sheet gets tallied at Lamai 28,825. Balance sheet gets tallied at 28,820. Right. Please check your answers as well. So Lamai, what we did was the pilot paper, which is the only paper available under the new syllabus. So what I'm going to do is now I'm going to share the paper, the answer to you all. Right. Okay. Right. Lamai, so we spent nearly 2 hours on discussing the paper, and we have 100% completed the paper. Right. All the questions were completed for you all. right? It's 100%. So please fill the feedback forms, right? So please fill the feedback forms, and you'll have my contact number as well. So if there's any question, you all can ask, and always use the WhatsApp groups as well, right? Okay. So Lamai, we spent 2 hours, and within the 2 hours, the 100% of the paper has been completed. And I know vLearning facts in the video content, I have covered the 100% syllabus with the past paper questions. So if you all have gone through the videos, definitely you will be able to get the definite A pass for the accounting subject, and for the price as well. You all can definitely go for the price. And please come to the other sessions as well. You all are getting the subject guidance for the other subjects as well. And not only that, please do continue AAT journey, and JMC vLearning will be there at AAT 2, AAT 3, and up until you become a chartered accountant as well. They are there to guide you. So before we wind up, is there any question, any concern for you to clarify? Is there anything to be clarified? Any question, any concern? Lamai? Yes. All okay, all good. Thank you, Tatsara. Right. Okay. Thank you, Lamai. Thank you for joining. And please WhatsApp me for any concern you all have, and use the WhatsApp groups as well. Right. I hope and pray for you to get A pass and the prize as well. Right. We'll meet up in the level 2 as well. Huh? Thank you. Thank you for joining. Right. Right. All the best for your exams. Huh? You all got 1 month. Be prepared enough. Huh? Right. Thank you, Lamai. Good night.